Whether it's a slowdown in China or the plunge in oil prices here in the United States, experts say the stock market was due for a major correction, technically a drop of at least 10% from its most recent high. For U.S. stocks, which have nearly tripled in value since 2009, it's a self-correcting mechanism that ensures stocks are priced fairly, says Joshua Brockwell at Azad Asset Management.
If you think of it as kind of a trimmer instead of a great earthquake, so the ground's kind of letting off a little steam, the market's kind of letting off a little steam right now, which is actually a healthy thing for stocks longer term.
Emerging markets in Asia and those that depend on commodity markets were hit even harder. Most depend on steady demand from China, which according to New York trader Ben Willis has not been transparent when it comes to its economic numbers.
The Chinese economy we thought was growing at 7%. It's probably only growing at half that. So a 50% reduction you need to reprice, and that's what you're seeing going on in the stock markets and in the commodity markets.
Despite the market volatility, experts say U.S. economic fundamentals, from annual GDP growth to employment, remain solid. That's why Mark Hamrick at Bankrate.com believes the central bank is likely to stay on track with planned interest rate hikes later this year. He spoke to VOA on Skype.
I don't believe the Federal Reserve officials are going to change their behavior based on several down days in the U.S. stock market. Having said that, if Federal Reserve officials believe that financial market conditions are sort of bleeding over into the real economy, that consumers are pulling back on purchases because they're scared of what's happening in the stock market, then that becomes an altogether different question.
Monday marked the 7th day in a row of steep losses in Asian markets. Key European indexes fell 4% or more, and Wall Street managed to cut earlier losses to 3.5%, its worst day in 4 years. Mil Arcega, VOA News, Washington.